Welcome back to Talk Tickers. It is Wednesday, February 18th, 2026.
Great to be here.
You are listening to the show where we stop looking at the flashing red and green lights on the screen and actually, start reading the documents that move them.
Digging into the fine print.
Exactly. If you are here, you are looking for the signal inside the noise of earnings season. And today we are leaving the sexy world of Silicon Valley software.
We are.
And we're turning our attention to the industrial Midwest. We are looking at DTE Energy, ticker symbol DTE.
And I can already hear the collective groan from the back of the room.
Oh, yeah.
Wait a minute. Why are we spending an hour on a regulated utility in Michigan? I thought we were chasing alpha here.
Right. Where are the 10x returns?
But you need to reset your assumptions. Because this isn't just about poles and wires and, winter heating bills anymore.
Not at all.
This is a story about the collision of the old world-heavy infrastructure, copper, regulation meeting, the absolute bleeding edge of new world demand. We are talking about the AI hyperscale boom and what it actually takes to keep those GPUs humming.
Exactly. This is one of the most interesting setups in the market right now because it sits right at that intersection. You have a company that just reported its Q4 2025 earnings, and on the surface, everything looks fantastic.
It looks perfect.
They beat earnings, they raised guidance, they have this massive deal with Oracle, but, and here's where it gets really interesting, the market reaction was complicated.
Complicated is a very polite Midwestern way of putting it. It was a classic fade, a textbook fade.
Right. So let's set the scene before we get into the numbers. We are looking at the price action from yesterday. The stock pops about 2.5% in the pre-market.
Big excitement early on.
Everyone is excited. It holds on to about a, 1.6% gain through the morning session. It looks like a breakout. And then
Gravity.
Gravity sets in. By the time the closing bell rings, DTE is flat. Completely flat. It gave back almost all of those gains. So the big question hanging over this entire discussion is why? Why does a company that beats expectations and raises its outlook get such a lukewarm reception from investors?
That is the multi-billion-dollar question. And, the short answer is that we are in a prove-it market.
A show-me market.
A show-me market, exactly. The market is looking at DTE and saying, okay, the Oracle deal is nice, we like the headline numbers, but show me the ink on the next contract.
Right. What have you done for me lately?
It's a moment of transition where this whole narrative of utilities as AI proxies is hitting the hard reality of, capital requirements and regulatory friction.
So let's unpack this. We have a lot to cover. We need to look at the results snapshot, the guidance, and then we're going to do a serious deep dive into this AI supercycle they are pitching.
Absolutely.
We need to talk about reliability as a political currency, which I think is a fascinating concept. And we definitely need to talk about how they are paying for all of this. Because let's be honest, infrastructure is not cheap.
It is the most capital-intensive business in the world. And of course, we'll wrap it up with our not financial advice segment.
Can't wait.
Where we pitch a trade that might just capitalize on all this volatility.
Absolutely. Let's start with the report card then.
Yeah.
The results snapshot. What did DTE actually deliver for Q4 2025?
The headline numbers were solid, pure and simple. For the fourth quarter, they reported net income of $369 million.
Okay.
But we need to throw that number out immediately, because in the utility game, we only care about one thing.
Operating earnings per share.
Operating EPS. And on that front, they posted $1.65.
Okay, $1.65. And for context, the consensus expectation was hovering around, $1.52 or $1.53?
Yeah, right in that ballpark. So that is a comfortable beat. They beat the street by over a dime.
Which in the utility world is a lot.
It's a huge deal. And I want to pause here because if you're a tech investor, a 10-cent beat sounds like a rounding error. If NVIDIA beats by 10 cents, nobody even blinks.
It's a yawn.
It's a yawn. But in the utility sector, these companies are designed to be boring. They're bond proxies. Their earnings are usually modeled out to the penny 2 years in advance.
Right, because they're regulated. They basically have a capped upside. There aren't supposed to be surprises.
Exactly. So when a regulated utility beats by roughly 8% in a single quarter, that is a massive deviation. It signals that something in the operational machinery is running much, much more efficiently than the analysts modeled.
So it's not just good news.
No, it's a signal that their cost controls, specifically regarding storm damage and O&M, operations and maintenance, are working better than anyone expected.
And looking at the full year for 2025, they landed at an EPS of $7.36, which significantly was above the high end of their own previous guidance range.
Which is crucial because management had previously given a guidance range. Usually you aim to land safely in the middle.
You want to meet expectations, not necessarily blow them away.
Right, you sandbag a little. But DTE landed essentially above the roof of their own guidance. They told the street where the ceiling was, and then they punched right through it.
That brings us to the outlook. They issued guidance for 2026 operating EPS in the range of $7.59 to $7.73. That represents a 6% to 8% growth rate over the 2025 midpoint. But here is the nuance. CEO Joy Harris didn't just give the range and walk away.
No, she didn't.
She explicitly signaled confidence in hitting the high end of that range.
That's a bold signal. I mean, usually CEOs like to preserve optionality. They like to set the bar low so they can easily step over it later in the year.
The classic under-promise, over-deliver.
But she is coming out swinging. She is saying, look at the top of the chart. That's our real target.
So what's driving that confidence? Because saying it is one thing, but delivering it, that's another.
These things. Primarily.
Yeah.
First, you have DTE Vantage. That's their non-regulated business.
Oh.
It's benefiting from renewable natural gas or RNG tax credits. These are projects where they capture methane from landfills or dairy farms and sell it as gas. It's a niche, high-margin business.
So that's one piece.
And second, just solid execution on the utility side. They are running a tighter ship, plain and simple.
So to summarize, we have a beat. We have a raise. We have a CEO sounding incredibly bullish. The management tone on the call was confident, I would say bordering on aggressive.
I would agree.
But the market tone, skeptical.
It's the skepticism of an accountant. The market looked at that beat and said, okay, that's priced in. We expected good news.
What's next?
That's next. What the market is sniffing around now is the capital requirement. They see the growth, sure, but they also see the massive bill coming due to build the infrastructure to support that growth. And that is why you saw the stock fade.
Right.
Investors are doing the math on dilution versus growth, and they aren't fully convinced yet that the equation balances in their favor, at least not immediately.
Well, let's get into the engine room then. Let's talk about the thing that is actually driving this entire narrative change. We need to talk about the AI and data center supercycle, because DTE isn't just powering refrigerators in Detroit anymore.
No, not even close. And this is the centerpiece of their whole strategy, the Oracle deal.
Okay, let's break that down. This was the headline grabber. A 1.4 gigawatt supply deal.
Just pause on that number for a second. 1.4 gigawatts.
It's a huge number.
For perspective, that is roughly the size of a nuclear reactor's output. It's enough to power a very large city, all for a single customer relationship.
And it's a long-term one.
It is a long-term marriage. The contract runs through February 2045.
2045. That is a 20-year commitment. But the most interesting part of this deal, and I think the part that DTE management was most eager to highlight, is the structure. They kept using this term ring fencing.
Yes.
And I think we need to stop and explain this because it feels like the linchpin of their entire bull case. If they don't get this right, the political blowback could just destroy them.
It's the most important concept in utility regulation right now. So imagine the utility grid as a giant swimming pool.
Okay.
Everyone, you, me, the local factory, the grocery store, we all pay a little bit to keep the pool filled with water. If a new swimmer jumps in, usually we all just pay a tiny bit more to keep the level up.
That's the traditional model. It's called cross-subsidization.
Exactly. But a hyperscaler data center isn't a swimmer. It's a whale.
A huge whale.
If Oracle jumps in, they drain half the pool. And if DTE asked Grandma in Detroit to pay to refill that water, the governor would fire the entire Public Service Commission.
So ring fencing is what, a separate pool?
Effectively, yes.
Yeah.
It's a tariff structure, specifically the Large Customer Renewable Energy Program in the Michigan context, where the contract states that Oracle pays for everything associated with their specific demand.
Everything.
Everything. They pay for the substation. They pay for the transmission lines connecting to it. And crucially, they pay for the new generation capacity.
So if DTE builds a power plant just for Oracle, Oracle's bill covers the mortgage on that plant.
100% of it. And here is the kicker, and why management was so aggressive on this point. They claim it actually lowers rates for Grandma.
Wait, how? If Oracle pays their own way, that should just be neutral, right? How does it become a benefit for existing customers?
It's all about fixed costs. The grid has billions of dollars of sunk costs, maintenance, overhead, legacy debt. When you bring in a massive new payer like Oracle, they don't just pay for their new stuff. They contribute a system access charge. that goes toward all the old stuff.
Oh, okay.
It's like having a roommate move in who agrees to pay 40% of the rent even though they only use one room. Your rent goes down.
That's a great analogy. So Oracle is the billionaire roommate.
Ideally, yes. Management estimates this benefit at about $300 million a year once all the projects ramp up. That is their political shield.
That's a powerful argument.
It is. They can walk into the state capitol and say, this data center isn't a burden, it's a donor.
Okay, so the Oracle deal is the bird in the hand. But the stock fade suggests the market is looking for the two birds in the bush. Management spent a lot of time teasing the pipeline.
Yes, this was the show me portion of the earnings call. And this is where it gets really interesting. They revealed they are in advanced discussions for another 3 gigawatts of load.
3 more gigawatts.
And these are hyperscalers. We're likely talking about the Microsofts, the Googles, or the Amazons of the world. And behind that 3 GW, they have a pipeline of another 3 to 4 GW.
That is a staggering amount of power. I mean, if they landed all of that, they would fundamentally transform the size of the company. It would, what, double their growth rate?
It absolutely would. But here is the catch. The part that got the market all excited and then, well, disappointed. Management teased that a second major agreement could be finalized in the coming weeks.
In the coming weeks. That is a very specific and I would say a very dangerous phrase to use on an earnings call.
It is a loaded phrase.
Yeah.
And I think that is exactly why the stock popped early and then faded.
Explain that.
When you say coming weeks, the algorithmic traders and the fast money, they hear imminent. So they buy the pre-market.
The machines jump on it.
Exactly. But then the human analysts sit down, drink their coffee, and think, wait a minute, weeks could mean 2 weeks or it could mean 8 weeks. And in the utility world, deals fall apart over zoning, over permits, over interconnect studies all the time.
Right. So the fade was the realization that there is friction. It's not just about signing a piece of paper. You have to actually build it. And that brings us to the infrastructure reality check.
Yes.
We talk about AI like it lives in the cloud, but the cloud is made of concrete and steel, and it needs power, a lot of power.
And this is where DTE was very honest, perhaps surprisingly so. They admitted that to support this load, it's not just about renewable energy. They are preparing for combined cycle gas turbines, CCGT.
Okay.
They are planning up to 2.8 gigawatts of new gas generation.
Oh, and I need to stop you there. You just said they were planning 2.8 gigawatts of gas generation.
Combined cycle gas turbines,
Yes.
CCGT.
Yes. We are in 2026. I mean, every press release DTE puts out has a picture of a windmill or a solar panel on it. How do they walk into an earnings call and say, actually, we're going to burn a massive amount of fossil fuels without the stock getting hammered by the ESG crowd?
It's the collision of idealism and physics. This is the part of the call that I found most honest, actually.
Right.
Look, they can build all the wind farms they want in the thumb of Michigan, but wind is intermittent.
It doesn't blow 247. The sun doesn't shine 24/7.
And an Oracle data center cannot tolerate intermittent. If the server farm loses power for 50 milliseconds, you lose compute. You crash the model. They need firm power, baseload power.
So gas is the only way to get firm power right now. Batteries aren't there yet.
Not at this scale. Not for 2.8 gigawatts. I mean, the battery technology to bridge a 3-day wind drought simply doesn't exist at a price point that makes any sense. So DTE is effectively saying, if you want AI, you have to accept natural gas.
That's a tough sell politically, a very tough sell.
It is. Which is why they're attacking on the letters CCS, carbon capture and storage, to every single mention of these gas plants.
Ah, the magic bullet.
They're promising that eventually these plants will capture their own emissions. But for now, they're building gas to power the bots. That's the reality.
So we have gas turbines, we have ring-fenced contracts, and we have a pipeline of deals coming in weeks. But none of this happens if the lights go out for regular people. And that leads us to our second big segment, reliability.
Reliability is political currency.
I love that phrase. Explain what you mean by that.
Think about it. If you're a resident in Detroit or Ann Arbor and your power goes out every time the wind blows, and then you read in the paper that DTE is building a massive new power plant for Oracle,
You're going to be furious.
you are going to be furious. You are going to call your state representative. You are going to protest. Reliability is the permission slip that allows DTE to pursue this growth. If they can't keep the lights on for the voters, the regulators will shut down the data center party before it even starts.
And DTE has had some struggles with this in the past. Their reputation for reliability hasn't always been stellar, but the numbers they presented on this call were essentially a victory lap.
They were impressive. They highlighted ISI 80,
SAD. Okay, break down the acronym for us.
It's the System Average Interruption Duration Index. It is the industry standard scorecard. It basically measures, in minutes, how long the average customer was without power over the course of the year.
So low A is better.
Much better. They claimed a nearly 90% reduction in outage duration compared to 2023. They called it their best all-weather performance in nearly 20 years.
A 90% reduction is huge. How did they achieve that? Is it just, better weather, less storms?
Weather helps, certainly. 2023 was a rough year for storms in the Midwest, and 2025 was milder. But you have to give credit to the operational changes. They have trimmed 40,000 miles of trees since June 15.
40,000 miles. That's nearly twice the circumference of the Earth. That's a lot of branches.
It is. And vegetation management tree trimming is the unsexy, boring work that actually prevents outages. Most outages are just tree limbs hitting power lines.
Right.
They're also hardening the grid, replacing old wooden crossarms with fiberglass, putting in new transformers.
Yeah.
And they are deploying Smart Grid Tech 2200 smart devices that can isolate outages automatically.
Right.
Their goal is to automate the entire system by 2029.
And what about storm response when the power does go out?
They cited a stat that 99.9% of customers were restored within 48 hours during recent storms. That is the metric that keeps the politicians off your back. 2 days. That's the magic number.
And from an investor perspective, this isn't just about PR, right? I mean, there is a financial incentive to reliability.
Absolutely. We call them emergent costs. When a big storm hits and knocks out power, DTE has to pay overtime, bring in crews from other states, replace equipment. That is expensive. It eats directly into margins.
It's a direct hit to EPS.
It is. So by hardening the grid and trimming the trees, they are reducing those emergency repair bills. Improved reliability protects the bottom line. It's not just good citizenship, it's good margin management.
So reliability is up, costs for repairs are down, and that clears the runway for the data centers, but building all of this costs money.
A lot of money.
A lot of money. Let's talk about the capital stack. How do we pay for this?
This is the part of the call where the CFO, Dave Ruud, earned his paycheck. The numbers are eye-watering. Their 5-year capital plan has increased by $6.5 billion.
Just the increase is $6.5 billion.
Yes, the total plan is now $36.5 billion over 5 years.
$36.5 billion. That is roughly the GDP of a small country like Latvia, just for one utilities infrastructure plan.
It is massive. And you can't fund that just from the cash flow of people paying their monthly bills.
Yeah.
You have to go to the market. And this brings us to the dilution question.
The dreaded D word.
Exactly. To pay for this, they are issuing equity. They targeted $500 to $600 million annually in equity issuance from 2026 to 2028.
So they're printing new shares of stock.
Yes. They set up what's called an ATM program at the market.
Okay, explain the ATM mechanism. How is that different from just doing a secondary offering where they sell a big block of stock all at once?
A secondary offering is a one-time event. They announce it, they price it, and they sell it. It hits the stock hard on one day, usually. An ATM program is like a drip feed.
Okay.
It allows them to sell shares directly into the market, day by day, hour by hour, at the prevailing market price. It's more efficient and allows them to time the sales, but for an existing shareholder, it's a constant headwind.
It's a slow leak.
Exactly. Every new share they print dilutes your ownership of the earnings. If there are more shares, the earnings per share goes down unless the total earnings go up faster.
And this explains the stock's sluggishness, doesn't it? If I'm an investor and I know you are going to sell $600 million worth of stock this year, I am not in a rush to bid the price up. I know there is a willing seller at every level.
Precisely. It puts a ceiling on the price. It's a wet blanket. Investors have to believe that the growth, the earnings from the new assets, like the Oracle Center, will outpace the dilution from the new shares. It's a race.
So DTE is saying, trust us, the growth is faster than the dilution.
And the market is saying, we'll see.
They also mentioned maintaining their credit rating, which seems critical.
Non-negotiable. They are targeting an FFO to debt ratio of about 15%. FFO is funds from operations. They have to keep their investment-grade credit rating.
Why is that so important?
If they get downgraded, their borrowing costs go up. And with a $36.5 billion spend, even a tiny increase in interest rates would be disastrous to the bottom line. So the equity issuance is painful, but it's necessary to keep the balance sheet healthy enough to borrow all that debt cheaply.
Okay, so we have the growth story, the reliability permission slip, and the funding reality. Now let's talk about the obstacle course, the political and regulatory minefield.
And in Michigan, that minefield is active. We have a gubernatorial election coming up in 2026.
And I imagine utility bills are going to be a hot topic on the campaign trail.
Affordability is the buzzword for every candidate, every cycle. No politician wants to run for governor while electricity rates are skyrocketing in their state. This creates a natural ceiling on how much DTE can ask for in rate cases.
So how does DTE defend themselves? How do they prepare for that fight?
They came armed with data. They pointed out that residential electric bills are currently less than 2% of the median household income in their territory.
Which sounds low.
It is relatively low. And they compared themselves to the national average, saying DTE bills are 18% below the national average.
That's their shield. We are cheaper than the average American utility.
Right. And then they pivot to the data center narrative. We need big tech to pay for the grid so you don't have to. That is the genius of the ring fencing strategy. It turns the data centers from a political burden into a benefactor.
It's a very clever narrative. We also have a rate case decision imminent, right?
Yes. In the call, they referenced February 19th, basically immediately after the call. The administrative law judge, the ALJ, recommended a 9.9% return on equity, or ROE.
Is 9.9% good? What's the context for that number?
It's decent. The industry average hovers right around there. It's not a home run, but it's not a punishment either. It keeps the lights on.
So not a disaster.
But the more important detail was the staff support for expanding the IRM, the infrastructure recovery mechanism.
Unpack that. What is an IRM? That sounds like jargon.
It is, but it's important jargon.
Okay.
Think of the IRM as a fast pass lane at an amusement park for rate hikes.
Okay.
Normally, to raise rates, a utility has to file a full rate case. It's a legal proceeding. It takes a year. It's public. It's messy. Everyone screams.
It's a circus.
It's a circus.
Yeah.
An IRM allows them to hike rates automatically for specific pre-approved investments like grid hardening projects without doing the whole circus every time. If they get that IRM expanded, it makes their cash flow much more predictable and reduces regulatory lag.
That sounds crucial for a company that's planning on spending this much money. They need that fast pass.
They absolutely do. It's key to funding that CapEx plan.
So we have covered the key pillars. Now let's step back and look at the investor context. Let's really synthesize why the stock faded. We've touched on it, but let's put a fine point on it.
I think there are three core reasons. Number one, the coming weeks cliffhanger.
The tease.
The tease. The market wanted the second data center deal today. They didn't want a promise. They wanted a press release with a name and a number on it.
Right.
When they didn't get it, the sell the news crowd stepped in and took their profits.
Reason number two.
Execution risk. We gloss over it, but building 3 gigawatts of new generation and transmission is incredibly hard.
There was a question on the call about local moratoriums on data centers.
Right, the not in my backyard problem. Exactly. Some communities are saying, not in my backyard. They don't want the noise. They don't want the water usage. DTE brushed it off, saying they're working with communities, but that is a real friction point. If a town votes to ban data centers, that pipeline gets clogged very quickly.
And reason number three.
Interest rates and dilution. We are in a higher for longer world, potentially. High CapEx plus high equity issuance equals a drag on the stock price unless the growth is explosive. The market is waiting to see if the growth is truly explosive or just, good.
It's also worth noting the macro view here. How does DTE compare to the broader utility sector?
Bride is trading right in line. DTE is up about 16.9% over the last year. The utilities ETF, XLU, is up about 17%. So it's a wash.
So DTE hasn't broken out as a pure play AI winner yet.
Not yet. It's moving with the herd. Investors are looking for the signal that separates DTE from the pack, and that signal is the execution of that 3 GW pipeline. Until then, it's just another utility.
So it's a show me story in a show me sector.
That's it in a nutshell.
All right. We have analyzed the past. We have dissected the present. Now it is time to look at the future with our favorite segment. The part of the show where we take off the analyst hats.
And put on the hedge fund vests.
And put on the hedge fund vest. It is time for, this is not financial advice.
And the disclaimer, we are two voices on a podcast. We are not your financial advisors. Please do not trade based on what we say. We are speculating for entertainment and educational purposes only.
If you lose money, do not blame us.
Please don't.
Okay. You have been looking at the options chain. You have been looking at the calendar. What is the pitch? What's the trade?
I call this trade the governor's gambit, or maybe the 30-day straddle.
I'm listening.
Here's the thesis. We have two binary events colliding in the next 30 days. First, we have the coming week's announcement of the second hyperscaler deal. That is a massive bullish catalyst. If they announce it, the stock pops. It validates the entire AI narrative.
Okay, that's the upside.
Second, we have the Michigan rate case decision and the potential for local political pushback, those moratoriums we talked about. That is the risk. The downside.
So how do you trade it? It sounds like you could get whipsawed.
You go long DPE February, March calls. You are specifically targeting that data center announcement pop. You are betting that Joy Harris wasn't bluffing when she said coming weeks. You want to capture that spike when the press release hits the wire.
But that's whiskey. That's a pure directional bet. What if the deal gets delayed?
That's why you hedge it. And here's the twist. This is the fun part. You pairs trade this against shorting a generic regional bank ETF, like KRE, that has exposure to Michigan commercial real estate.
Whoa. Okay, connect the dots for me. Why the banks?
Think about the downside scenario.
Yeah.
If the data center build-out hits moratorium snags, or if the rate case is harsh because of political pressure, who gets hurt? DTE, yes, but also the local economy. The commercial development narrative in Michigan takes a hit. If DTE can't build, the construction loans don't happen, the land deals don't close, the whole ecosystem freezes. By shorting the regional banks, you are hedging against the local friction risk while staying long. The AI global demand upside on DTE, it's a creative hedge.
That is complex. I like it. It's very pot shop. Do you have a simpler version for the people who don't want to short regional banks on a Tuesday?
I do. I have a much simpler one. I call it the wait for the ink front run.
Let's hear it.
You buy the DTE 2028 LEPS, long-term equity anticipation securities. Specifically, I'm looking at the January 2028 calls.
So you're going out 2 years. Why that duration? Why so far out?
Because of the dilution schedule. The CFO was very clear. They are issuing $500 to $600 million in equity in 2026 and likely more in 2027. That creates that natural ceiling on the stock price in the short term. The algorithms are programmed to sell every rally because they know supply is coming.
So buying short-dated calls is fighting the Fed, effectively. You're fighting the CFO's ATM machine.
You are. You're swimming upstream. If you buy a 6-month option, you could just get crushed by the ATM machine printing shares day after day. But if you go out to 2028, you are jumping over the heavy CapEx cycle.
Ah, I see.
You're positioning yourself for the moment when that 3-gigawatt pipeline converts from construction cost to revenue and earnings.
You're engaging in time horizon arbitrage. The market is pricing the Stark based on 2026 dilution. You want to price it based on 2028 earnings power.
Exactly right. If they hit the high end of their 6 to 8% growth targets, and remember that target excludes the unsigned pipeline deals, we could be looking at $8.50 or even $9 in EPS by 2028. Put a standard utility multiple of, say, 18x on that, you're looking at a stock significantly higher than where we are today.
And the APS give you that leverage.
The APS allow you to rent that upside with limited capital exposure, and you get to bypass the boring, dilutive slog of the next 12 to 18 months.
That is a compelling long-term bet. You endure the boredom now for the excitement later.
That's utility investing in a nutshell, isn't it? Or at least it used to be.
It usually is. But DTE is trying very hard not to be boring.
They are trying to be exciting. And that is both their biggest opportunity and their biggest risk.
So to wrap this whole thing up, DTE delivered the numbers, they beat the street, they have the story oracle is signed, the pipeline is full.
The narrative is there.
But now they have to navigate the politics, they have to placate the locals, and they have to pour the concrete.
They have to turn the PowerPoint slides into power plants.
Yeah.
That's the hard part.
Exactly. And the final thought for the listener to take away from all this.
The energy transition is expensive. We all know that. It's a huge undertaking. But for the first time, utilities have found a rich tenant, big tech, who is willing to pay the rent.
A tenant with very deep pockets.
The deepest. So the question is, can DTE keep the locals happy while they build this landlord empire? Can they serve two masters, the grandmother in Detroit and the AI server farm? The answer to that question will determine if this stock breaks out or just drifts along with the sector for another year.
We will be watching for that press release in the coming weeks. Keep your eyes on the tape, and we'll see you for the next sprint.
See you next time.